Hello traders, Gary Wagner here just after 12 o'clock in Honolulu, 5 o'clock in New York. It is Tuesday, January 14th, 2020, and this is the Daily Report for Gold and Silver. The fact that there will be a signing of the Phase 1 trade agreement tomorrow continues to weigh heavily on the safe haven asset class, meaning gold and silver. Those two precious metals trading lower today. Platinum and palladium trading higher. Palladium actually moving to yet another all-time record high. But that has been really what we've been seeing in that precious metal since about the 23rd of December, even on a consecutive basis. On today's show, I want to talk about the ramifications of the trade agreement now that some of the context has come out and we can begin to evaluate exactly what has been accomplished and what an effect that will have on the global economy. But first, let's take a look at current pricing. Although gold is trading approximately $10 above the intraday low achieved today in gold when it hit $1,536.40. It is currently fixed down $3.60 at $1,547. The interesting component that we'll look at as we pull up our technical studies is the fact that today's open was below that 1551 area, which was a level of potential support that will probably now become resistance. Again, gold down 360. Silver lost approximately 1.03%, almost 19 cents, back below $18 at $17.81. We had platinum gaining about 0.7% today, $6.50, crawling back to $1,000 per ounce, currently at $988.60. And finally, palladium just scoring consecutive gains with the shortages that are currently around, and it is simply a supply-demand scenario. $2,131.70 after factoring in today's gain of over 2.5%, $52.60. Traders, let's take a look at our current technical studies. Considering that gold was trading to a high of $1,613 last week, today's low at approximately 1536.40 has shown just how much we have seen this market retrace over the last week and a half. I'm circling that area right now, and today's market move was nonetheless bearish indeed as it opened below a key level we've been watching, which is the 38% retracement at 1551, basically eliminating that as a potential level of support and almost certainly making it a very good candidate as a resistance area should we see a further decline in the market. Now, the next level that we'll really want to focus on if gold prices continue to track lower, it's got to be the 50% retracement. That comes in at 1531.70. And of course, below that is a major level of support that comes in at around 1512.30. It is the 61.8% Fibonacci retracement. And just above that particular price point is 1520. And why that is significant as far as I'm concerned is we can see some strong activity in which it acted as an area of resistance. And of course, resistance and support are part and parcel of the same thing. One man's ceiling is another man's floor. So we'll have to see with the signing tomorrow and strong equities markets and strong global growth because of the potential of this Phase 1 agreement, we could see a further decline. If it does decline and hits 1531, we want to see how that reacts, if it finds any kind of support. If it does, we could see a little bounce. Now, that would be a technical bounce because, as I said, there are a couple of models we want to look at. One is that the market will Find support at 31. We'll go into some sort of a B wave. We calculated that out yesterday. That would come in at around 1592, and then possibly even one final C wave, taking us to 1512, the 61.8% retracement. The second model that we could see unfold is that this particular sell-off will be much deeper than we had anticipated, taking it down to the 0.618% retracement before moving up anywhere between 60 and 75%, which would be between, call it 1570 and 1580. We will probably see some sort of a technical bounce and support for gold come in at around 1530. For right now, I am recommending that you do maintain our neutral stance. We want some concrete technical evidence that we found some sort of a bounce. And then, as I said at the end of last week, beginning of this week, what we could look for would be to play to the upside, the counter wave or the B wave, and then for aggressive traders that like to short the market, they could look to implement a short position on that final C wave down. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.